Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have David Kamara. David has been a real estate investor since buying his first duplex in 2006. Since then, he has transformed the portfolio from residential, single-family, and duplex units to focus on larger multifamily investing, including apartment buildings and townhouse communities, with his latest acquisition being a 124-unit property. So thank you so much for being on the show, David.
Thank you very much, Charles. Thanks for having me.
So give us a little background on yourself, both personally and professionally, prior to being involved in real estate investing.
Yeah, so I was a management consultant. Before that, I was a programmer. So my background is computer science. Got my degree up here at Michigan, University of Michigan, moved to Chicago with my wife. Did the young urban professional life, which was quite fun. And after we bought our first house is when I really both my wife and I got interested in the real estate space and decided that we should probably do something further than just buying our personal house. So a few years later, we bought a duplex and a threeplex. And the plan at the time was to continue buying single family and just keep on buying single family as we could afford to. But then, of course, life happened. We had kids, work changed. There was the downturn, moved back to Michigan. So we kind of got off that, path for a little bit. And then once the management consulting career took off and I opened my own management consulting firm, we now had this money that we wanted to invest, and we started investing in multifamily.
Okay, cool. Awesome. So why did you choose real estate as your investment vehicle? Was it something that you learned from starting with smaller stuff and it was the way of scale, or?
So I actually did some soul searching on this. As a consultant, you're very analytical. You're always comparing whether it's businesses, you're benchmarking businesses against businesses and how they're performing, or different parts of the P&L. In this case, I actually looked at a lot of asset classes to see where do I want to put my money. And when I started, all of or most of the substantial part of our portfolio was in stocks. And we did very well in that asset class. But the difficulty for me was you get hit with all the taxes, right? It's not structured in a tax efficient manner. And it's also not passive, right? So I had to be very active, and I enjoyed doing that with stocks. But at some point, it just came out that it's a lot of work, and it's a lot of things that you really have zero control over, right? What companies are going to do and whether there's accounting irregularities is just totally out of your control. And real estate provided that great return with relatively little risk. And also allowed you things like leverage and the tax efficiencies that just made it the investment of choice for us. And I actually summarized these thoughts in something I wrote called the personal cash flow formula. So I kind of have shared that and made that available to other folks to take a look at.
Interesting. So I was reading before our interview here, and it said about one of your first deals was an 18-unit in Chicago. So can you tell us a little bit about that, how you found it and how you funded it?
Sure. So that was actually my second deal. And it was, so originally when I did the first bigger multifamily deal, I was thinking, right, I'll just sit on it for a year or two, see how it performs before I do anything else. But literally it was, I think, 2 months after closing that first bigger deal that we did, that this deal came around. And at the time I was working as a management consultant in Chicago, and I also had lived in Chicago. So we had moved back to Michigan, but I found myself in Chicago a lot. And I mean, it's exciting. It's a large metropolitan area. Pricing is definitely different from in Michigan. And the deal, however, did make a lot of sense. So I'd been looking at multifamily asset properties in Chicago, and And a lot of them just didn't pencil out, right? People asking too much or the cash flow wasn't there. And on this one, it made sense. So I really had to ask myself, why would I wait a few years, right? There's not really a good reason not to do it. And it wasn't that big of a deal that it was too scary, right? I mean, at this point, the model was pretty clear. So we decided to move forward and do it. The funding for
And
the funding for it was mostly ours. Like we didn't have to syndicate or anything. I guess the backstory to how the whole thing started was that my wife and I were trying to find a way for me to travel less. Because with the management consulting career, I was traveling a lot. I was on the road many weeks a year. And we had accumulated a significant amount of funds that we felt we wanted to invest in multifamily real estate to generate the cash flow so that I came home. So this did kind of fall into that scheme, and it made things simpler. And we said, sure, we'll fund it and we'll do it. There were a couple of things that we learned along the way with this deal that I can speak to if that makes sense here.
Yeah. Well, what kind of obstacles or hurdles did were in your way when you bought this deal? Was it a heavy value add, or is there minimal value add to do?
It was a minimal value add deal. The deal was cash flowing. So part of our philosophy is minimize risk, and pretty much everything we buy is 90% plus occupied when we buy it. The value play on this was the owner wasn't paying attention too much to it. Some of the units were a bit older and more tired. So kind of light cosmetic renovations, things like kitchens, bathrooms, that kind of stuff. It was brick building, so the exterior was pretty solid. Roof was good. No real mechanical, any of those types of issues that were a major concern. But just in the process of buying this deal, right? So this was our first, I think, agency loan. So our first Freddie Mac loan, small balance loan. And what happened was it's an 18 unit, so it's a small property. And of course, as anyone who's done any of those loans finds out, they're very particular about occupancy, and not just physical occupancy, economic occupancy as well. So with an 18 unit, if you drop down to 2 vacant, you essentially have less than 90% occupancy. You had 89%, just 16 out of 18 occupied. So we had to make sure that the sellers were able to put a tenant in there that was credible and had the right essentially credit history and checked out, not just put anybody into the building before we closed. Also, in this particular town, the municipality does its own inspection, which is more rigorous than the typical Freddie inspection that happens. And so what ended up happening is we were ready to close, but the municipality wouldn't allow the seller to close until they had actually checked off these boxes of all these repairs that needed to get done. So we had to juggle a little bit with closing timing, and when we locked our rate on the loan. It was a very interesting experience. Things worked out. We ended up buying it. It's good, but it was one of those where you learn a lot when you do anything for the first time.
Yeah. Very interesting. Very interesting. So on your next deal, you went, I think it was a 37 unit, and you actually JV'd this one. So you brought in, I guess it was your broker from the 18 unit deal. Is that correct?
I was the broker from my first deal, actually. So
okay.
The 37 unit was in Michigan. The same broker that I bought the first deal from brought it to me, and actually it was happening at the same time as this Chicago deal was. On this one, the broker found the deal on the MLS. So he wasn't the listing agent, but he found it on the MLS, and he was like, David, you should take a look at this. And so first of all, this kind of talks about the relationship with the broker and how important that is. So this broker was a really cool guy, very aggressive young guy. And I really liked that he thought of me for this deal, right? It wasn't a super large deal, but it was 37 units. And frankly, ended up being one of the better deals that we bought in terms of pricing. And just the deal was mispriced. It was, like I said, it was listed on the MLS. It sounds like the sellers didn't quite know where to list it or how to sell it, or they just were kind of fumbling through it. But I partnered with the broker to kind of incentivize him to bring me similar deals in the future. So really his contribution was he found this great deal that was priced very well. And he said, hey, I'd be willing to invest with you. So he understood my trajectory of where I was going. I wanted to buy a bunch of assets for myself. And he said, yeah, I mean, I'm interested in the same thing. I'd like to have a long hold period. I'm not really looking to flip anything. I like you, I trust you, I'd like to be involved in it. So the way we structured that was basically, hey, Mr. Broker, I actually don't need your money on this deal, but since you did bring it to me, sure, let's do it. And yeah, I'd like you to be part of it. And I'd like you to also kind of consider me, because at this point, I'm not a big investor, right? I'd like him to consider me as somebody who he'd be bringing deals to. And happily that relationship has continued, and I bought a number of other deals from the same broker. In terms of responsibilities on it, essentially his contribution was finding that deal and helping negotiate it, but the rest of that was mostly myself and my wife.
Interesting. So he found that deal in the MLS. It must have been just mom and pop people that were listing it with friends of theirs or a family member, the normal kind of real estate agent. Yeah. It's amazing because I've found and purchased commercial multifamily, commercial mixed use off MLS before from brokers. So it's just amazing that even if you're looking for larger apartment buildings, make sure you always have that relationship with someone that has access to MLS. And they could be the same person that you're using for larger stuff or someone different, because they can just set up they'll set up an alert there for you for number of units, and it comes on there, and you'll get an email. And I doubt they're going to have other people, or many other people are doing that. And that's a great hack too, especially when we're in the marketing cycle that we are in right now. But that was great that you guys were able to JV with him. I imagine he rolled some of his commission into the deal as well to help you guys close.
He actually brought cash
Nice.
to the table as well. I think he did roll a commission in, but he also brought cash in because he really wanted to not just be like, yeah, I'm just here for the services, but he was like, I'll put cash on the line. So yeah, it was a good partnership.
So you did a deal with him prior, so you knew who he was. People are always like trying. I hear people talking to me, they're like, oh, we're partnered with my broker, and they can roll their commission in and we can use that for down payment. Well, but you're partnering with them now for 5 or 7 years. So you have to make sure that you know who are, not that you're just going for the quick percentage of money that they're going to put in there. So you actually did a deal with you, which is awesome. So you knew who he was, and you must have had multi-year experience with him and a track record of both of you before you moved to kind of the next phase in your relationship as actually JV partners. So that's great. That's an awesome way of doing the deal and keeping a lot of it for both of you without any other investors.
Yep.
So let's talk about your first syndication deal. So you went from this 37 unit, you go to a 94 unit, which was your first syndication. I mean, how did you find the deal? How did you raise money for that? Because were you kind of working and farming some of your professional people in your network to invest with you while you were doing these smaller deals? Or was this something that when you found it, now you had to start reaching out to other people to start asking for money?
Yeah, so it was a very interesting evolution. There was a deal in between, I think the 37 unit and the 94 unit. Also happened to be actually from the same broker, but and the 94 unit was from the same broker as well. But interestingly, people just started reaching out to me. So I was still working my management consulting career, and I was excited, right? So I was talking to my friends, my colleagues, my ex-colleagues, my clients. I was telling them what I was doing, and they actually prompted me to think about syndicating. Again, our original goal was just to buy properties for ourselves and not really partner with anyone. But literally, I mean, my clients would say, listen, tell me more about these buildings that you're buying, because this sounds very interesting. We want to be exposed to real estate more, right? But we don't want to have to answer phones about tenant issues and toilet blocking and all that kind of stuff. Yeah. Like we just want to invest in real estate, kind of like the stock market. And so, I mean, at first I was like, yeah, haha, great, go do your own deal. But then multiple people said the same thing. So I started thinking about it, and like, I mean, literally people were saying, can we invest with you? And so, I mean, after enough people had said this, my wife and I talked about it and said, well, sure. I mean, we will run out of our cash at some point soon. So maybe it's not such a bad idea to partner with other individuals and take our money further, and also sprinkle a little bit more cash and more deals, right? So diversify
Mhm.
some. So that's really how syndication came about for us. And no, the first deal was pretty simple, and for everyone we do, we put our own cash into, and a significant amount of cash. I think on that first deal, we put in about 250. Um, so people came and said, we'd like to invest. And again, not really wanting to have too many investors in any one deal, we said, fine, as long as you can bring in $100,000, that's our minimum raise.
Mm.
Let's do it. And so that's how that first deal came about. I mean, it was really just saying, okay, guys, we're now doing this since you guys requested. Let's see who's really going to write a check.
Mhm.
And again, it kind of came together fairly seamlessly. Same broker.
Mhm.
um, and that was a deal that I was going to pass on, but he said, listen, you should really take a look at this one. Um, it's a very good property. It shows well. It's a bit more expensive on a per door basis, but it's in better quality than some of the things you bought before. There's more doors under one roof, so to speak. So you have economies of
Mhm.
scale. So he really made us reconsider it. We went back, looked at the deal, looked at the numbers, and said, sure, let's do it. So that was that one. It came together again in very quick succession. I think that was probably 6 to 8 months after the first couple of deals we did.
So how does the general partnership team look like on that deal? Is it just mainly you? Is there a broker? Did you bring anybody else on with you to help you close the deal, raise the funds, or handle any of the asset management going forward?
No, it was just me and my wife. So my wife and I kind of
Okay.
partners. The broker did not put money in that deal, and we didn't bring him in on that one as a general partner. Um, we did all the fundraising. We put the deal together. We closed it. We didn't really need any partners to make it happen. So yeah, it was just us.
So you've kind of progressed. I mean, you bought in 2006 with smaller residential multifamily, and then you've kind of grown into buying 94 unit properties. So how have your goals and real estate investment goals and strategies adjusted since you've started investing? Is it just because you wanted more time and you want the scale faster, or is it because you were looking for something different and this was an easier way of getting to that goal by bringing on the syndication, working with other people?
Yeah, I would say. I mean, that's an interesting question. For the most part, our strategy is still the same, right?
Mhm.
So really, we started out with trying to generate passive cash flow for ourselves as a family and for investors. I mean, as we got to syndicating, um, I think I mean, we do bigger deals, so maybe from that perspective, it's a little bit different.
Mhm.
Um, but I mean, at the heart of it, we're still doing the same thing. Um, I would say maybe now we're a bit more cognizant of marketing a little bit more, having a blog, that
Yeah.
kind of thing. Um, because as you buy more deals and buy bigger deals, you do exhaust your network of people that can write checks, right? So from
Mhm.
that perspective, I think that's the one thing that's different. But I think our strategy has really never been to do a ton of deals, which has been nice and frankly,
Mm.
I think has kept us out of trouble because we don't have to go do another deal anytime, really. We only do deals that we think fall into that sweet spot for us where we have an advantage, where we know the area better, we can provide value, where we feel like it's a low risk, fairly high reward situation. Um, but yeah, fundamentally, our strategy has always been invest with the cash flow, do some value add, but that's not a heavy part
Yeah.
um, of our return. So no, it's fairly still the same, I would say.
Interesting. Yeah. It's great that you're doing the light value adds. I mean, with light value adds, you get the agency debt, you're buying 90% plus economic occupied properties so that the risk is very minimal for you and your investors. So it's very easy to sell those, let's say, and without better words, to your investors. And it's also knowing that there's not much that you have to change. You're just kind of finalizing and fine tuning the property that you're taking over. So it's a great business plan that you guys work with.
Yeah, and
Um,
I
I met.
would say that there's fewer properties that fall into that category in the market. So again, maybe
Mhm.
that's why we do not as many deals. I think
Yeah.
some choose to do I mean, a little bit more kind of repositioning of properties where they do a bit heavier lifts and more difficult remodels. We've so far stayed away from that, and it's worked for us for the reasons you mentioned. It's lower risk.
Yeah. Yeah. Awesome. Yeah, that's great. So I imagined other investors that want to be active reach out to you and ask for your advice on their particular situation. And I want to see what kind of common mistakes do you see other real estate investors make?
Yeah, so I think especially where we are today, the one thing that I see is a lot of people just have a bit aggressive assumptions, a bit more aggressive than maybe they have
Hmm.
vetted out, right? Um, that's one. I think another one is probably paying a bit more upfront. I think the current cap rate compression has really pushed pricing up, and I think just it's a fact that a lot of people have raised a bunch of cash, and so there's a lot more money chasing deals. Right? It's just kind of how it is. So being very selective and being patient, I'd say, is a virtue, and some people may afford to pay a bit more than I would. Um, and not that that's a mistake, but again, you just have to know what your expectation from your investors is,
Mhm.
and what can you go execute, right? So those are kind of the two things that I caution people about. And I think in general the space has become a bit crowded in that specifically multifamily is getting more attention
Mhm.
post-pandemic or at the tail end of the pandemic, hopefully, just because some of the other real estate asset classes have not performed as much, right? So hotels haven't performed as much, retail, so office space. So a lot of those traditional investors that would invest in those assets seem to be looking at anything that cash flows well and has good returns, which is multifamily.
Interesting. Yeah. Yeah, a lot of people chasing yields from other real estate asset classes, that's for sure. So, David, what do you think are the main factors that have contributed to your success?
I would say staying disciplined is very key,
Mhm.
and know what your strengths are, right? So we know that our strength is not doing major rehabs of properties. We just don't have that skill set, at least at this point, we don't. We might delve into that in the future. But I think, yeah, so you have to know where you can do well and what you can accomplish. Um, so being disciplined and staying patient. I would also say having the support of my wife in this as we work together has been very key, right? I think a lot of families and spouses would realize or recognize that sometimes it's hard when you're pulling in two directions if you're working as a trying to work as a team, but not everybody's on the same page. So I've been very fortunate that my wife is exactly on the same page with this. Um, I mean, at the end of the day, you have to do your homework, you have to do the analysis, you have to know the neighborhoods, you have to spend time with the brokers. There's no substitute for that. And you have to
Yep.
be really attentive to detail, right? I'd say real estate's a business where, sure, it's less complicated than many other businesses that I've seen, but you still have to know your numbers, right? And if you make a few mistakes, you can still be okay, but just don't make the big ones.
Yeah. Yeah, that's great. That's great. The other thing too that kind of add to what what I feel one of your factors is that when we were talking about your first property is that you and your family had your why in place, which was more time with your family. So that's a huge goal for you to work towards, and that's awesome. It's great to have that kind of guiding light of where you're going, so you know, hey, this property is going to be a lot of work. It's going to be a lot of management. It's going to be a lot of asset management, project management. Let's pass over it and then stick with ones that are going to be a little easier that we can use some of our skills to, to clean up and to get rented to better tenants, higher paying tenants and stuff like that. So that's awesome.
Yeah, I think having
So,
clarity as to why you're doing it absolutely is a key thing, because it helps us figure out what deals make sense for us, but also to your point, what I mean, again, for me right now, it's really all about cash flow, right? So for any given deal,
mhm,
there's an element of how much cash flow is this adding to our income statement, our personal income statement, our personal cash flow
yeah,
statement on a monthly basis. And so you kind of have to really understand that, because I think some people do get wrapped up in let's do the next deal, let's do the next deal. And at some point, I mean, if you're doing too many things, it's more difficult to make mistakes.
Yeah. No, that's great. And you also have a strict criteria that you're sticking with for that cash on cash return, because obviously that leads to your goal as well as having passive income. And I imagine as well with your investors. So it's great to have that alignment of interest between both the general partners and the limited partners. So, but David, how can our listeners learn more about you and your business?
You can find us at our website, which is Cape Sierra Capital. It's CAPE. SIERRA capital.com. And while you're there, you can download my free ebook, which is the personal cash flow formula. Take a look. I think it should help you.
Okay, David. Well, thank you so much for coming on today. I will put those links into the show notes, and looking forward to connecting with you in the near future.
Thank you. It's been a pleasure. Thank you, Charles.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.